I'm so sorry, ma'am. I know you need this medicine, but it looks like it's not covered by your insurance.
Yeah, unfortunately, I had to deny that one.
Wait, who are you?
I'm your insurance company's pharmacy benefit manager. I get paid based on the price of a medicine, and I don't make as much money off this one.
No one should stand between you and your medicine. Visit phrma.org/middleman to learn more. Paid for by Pharma.
This is Optimal Finance Daily, episode 2404. 6% is the new 4%. By Paula Pant of affordanything.com. And I'm your host and personal finance enthusiast, Diana Merriam. This is the show where I read to you from some of the best personal finance blogs on the planet. Let's get right to today's post and start optimizing your life. 6% is the new 4%. By Paula Pant of affordanything.com. Today's article is extra nerdy. Pull on your Coke bottle glasses and let's run through a little bit of math. Ready? Let's go. If you're retiring on index funds, you might plan your retirement on the 4% withdrawal rule. But if you're retiring on rental properties, you could use the equivalent to a 6% withdrawal rule. This holds true even if total returns on the two investments are the same. Why? Two reasons. Number one, the returns on a rental property bias towards an income stream rather than capital appreciation. And number two, rental properties don't hold the same risk of withdrawing the principal. If you're thinking, Paula, I have no idea what you just said. That's cool. Here's a breakdown. 4% breakdown for index funds. Let's assume your entire portfolio consists of stocks and bonds, split 50-50 into each bucket. According to the Trinity Study, an industry-shaking retirement study conducted by 3 Trinity University finance professors in 1998, you can safely withdraw 4% in year 1 of retirement and 4% adjusted for inflation every subsequent year, while maintaining a strong likelihood of not running out of money. This means that $1 million portfolio would allow you to withdraw $40,000 in year 1 and $40,000 adjusted for inflation every future year. Of course, the portfolio would grow at a rate that's higher than 4%. Let's assume that the portfolio grows at a rate of inflation, which is 3%, plus it accumulates real growth after inflation of another 6%. In this example, the portfolio enjoys a total return of 9%, but it's risky for you to realize those total gains. Markets are volatile. And in retirement, your first objective is to not risk the loss of your initial principal. You don't want to tap into your nest egg in retirement. In order to curb this risk, you restrain your withdrawals to only 4%. As a side note, there are many modern retirement experts, like best-selling author and podcast guest Larry Swedroe, who believe that future total returns may be closer to 6 or 7%, which means that when it comes to safe withdrawal rates, 3% is the new 4%. Eek, that's a scary idea, but it's worth considering. At any rate, that's a different discussion for a different article. That's the 4% breakdown for index funds. How does that compare to rental properties? Let's take a look. Rental properties, a comparison. Let's take the same $1 million portfolio. You sell out of your stocks and bonds and reinvest the entire balance into rental properties. By the way, I would never recommend doing that. I recommend diversifying between both index funds and rental properties, but let's run with this thought experiment for the sake of example. You buy rental properties that meet the 1% rule, which states that the gross monthly income must be at least 1% of the initial purchase price. This means that your $1 million rental investment brings you $10,000 per month in gross rent, mortgage-free. Of course, gross revenue and net profit are not the same thing. Your properties have overhead, including property taxes, homeowners insurance, repairs, maintenance, management, capital expenditures, and vacancies. These operating expenses follow the 50% rule, which states that half of your gross rent will go towards this operating overhead. This means you spend $5,000 per month on overhead, and the other $5,000 is your monthly net cash flow. That's $60,000 per year. That's a supremely nerdy way of saying that the same $1 million will produce cash flow of $40,000 per year if it's invested in index funds but cash flow of $60,000 per year if it's invested in rental properties. In the world of rental investing, 6% is the new 4%. What about total return? Let's conservatively estimate that the rental properties keep pace with inflation, but nothing more. That's another 3%, which brings the total return on the properties to 9%. Since you bought the properties mortgage-free in this example, there are no additional returns in the form of equity growth through principal payoff. In this example, the total returns on the index fund portfolio and the rental portfolio are the same, but the rental returns bias towards cash flow rather than appreciation, which gives you the ability to enjoy harvesting those returns at the 6% rule rather than the 4% rule. In addition, you don't risk tapping the principal when you live on the cash flow from a rental property. The principal, which is the equity in the home, stays intact as long as you don't borrow against the equity and as long as there's no major housing crash as there was in 2008, which also crashed the value of index funds as well. Imagine the concepts of growth versus dividend. The rental properties are analogous to a stable blue chip stock that pays a 6% dividend but only grows at the rate of inflation. Your index fund portfolio, by contrast, pays a much smaller dividend but grows at a rate that's higher than inflation. The two baskets of assets may have the same total return, but those returns are expressed in different ways. The expression of the returns on a rental property are more suited to retirement. That's why rentals are a great store of wealth. They're a lower risk and higher cash flow form of wealth preservation than equities. If those few paragraphs sounded like womp womp Charlie Brown's teacher to you, don't worry about it. I'm trying hard to relate this in a way that's not too jargony, but I think I need more coffee. The big picture here is that in rental investing, 6% is the new 4%. Yeah, but I don't have $1 million. If you're thinking, great, Paula, but I don't have $1 million in cash, the percentages apply no matter what amount we're talking about. Let's say you have $100,000 in cash. You invest this $100,000 in index funds. You withdraw 4% or $4,000 in year one, and that same amount adjusted for inflation every subsequent year. Or you invest this $100,000 into a single family rental property in the Midwest, which you purchase free and clear. Your property manager rents it out for $1,000 per month, which is $12,000 per year. You spend $6,000 on operating overhead. You keep the other $6,000. The property value and your rent keeps pace with inflation in the following years. It's the same $100,000. In one example, it brings you $4,000 per year. In the other example, it brings you $6,000 per year. That's why I like rental investing. If you're looking for the next hot growth stock like Apple in 2005, go elsewhere. But if you're looking for a stable investment with a strong dividend, rental properties are the way to go. You just listened to the post titled 6% is the new 4% by Paula Pant of AffordAnything.com.
I'm so sorry, ma'am. I know you need this medicine, but it looks like it's not covered by your insurance.
Yeah, unfortunately, I had to deny that one.
Wait, who are you?
I'm your insurance company's pharmacy benefit manager. I get paid based on the price of a medicine, and I don't make as much money off this one.
No one should stand between you and your medicine. Visit phrma.org/middleman to learn more. Paid for by Pharma.
Between the kids being home and hosting, everything in our house gets used up in summer. With Instacart, I can save money by stocking up on all my favorite summer brands. I save time by getting everything delivered in as fast as an hour. And I save myself a sink full of dirty dishes by stocking up on paper plates for the annual summer cookout. Save more on summer essentials? Spend more time enjoying summer. Add summer to cart. Download the app to get free delivery on your first 3 orders. Offer valid for a limited time. Minimum $10 per order. Additional terms apply.
Does this article have you dreaming about real estate investing? Maybe you're already doing it, or maybe like me, you've been watching from afar, wondering if it's the right investment option. While this article is certainly enticing when it comes to returns and cash flow, it doesn't address the fact that investing in real estate is simply more work than passively investing in stocks. And that's not a reason not to do it. Effort is the spice of life after all. It just makes me want to enter this type of investment with eyes wide open at a point when I have bandwidth to take on the extra effort involved. Many people talk about rental income as passive income, which is partially true. I look at it as front-loaded effort income. It takes effort to find the properties that adhere to the 1% rule, find the right tenants and/or property manager, deal with maintenance, etc. You don't have to worry about unclogging toilets, replacing the furnace, or tenants trashing your investments when your money is in the stock market. I think I also have hesitations about my money being locked up in a tangible asset. Stocks are pretty liquid. If something horrible happened and I needed access to more money, I can more easily sell stocks than sell a rental property. That's why I'm more interested in adding real estate to my portfolio when my net worth is a bit higher. As I continue to think about diversifying my portfolio and expanding on my various sources of income, I really do see myself investing in real estate eventually, but it's a decision I don't take lightly. And that'll do it for today and another installment of Optimal Finance Daily. Have a great start to your week. Thank you for being here every day, and I'll see you tomorrow where your optimal life awaits.